All right, so let's jump into this. Let's start chapter 2. Okay, we're on page 21, and we're going to start with the balance sheet. So, what is a balance sheet? You guys remember this is a review of your accounting. So, what do you remember from accounting? What's your balance sheet do for you?
It shows all your assets, liabilities, and stockholder equity.
Okay, it shows assets, liabilities, stockholder equity, right? The balance sheet, like we said, we have assets, we have liabilities. Okay, assets are on one side, liabilities are on the other. How are they or how are they listed? Do you remember?
In order of liquidity.
There you go. Matt's jumping in to help James. James got the first part. Matt understand order of liquidity. What do we mean, Matt?
How fast it can be converted to cash.
How fast it can be converted to cash. So if we look at the bottom of page 21 there, you kind of have a balance sheet put together, right? And we're going to expand on that a little bit with the notes here. So we have our assets. Our first assets are current assets. How fast they're converted to cash. Remember, our current assets are, and folks, you need to remember this: cash, accounts receivable, and inventory, right? Cash is at the top because it's liquid. It's already cash, right, Matt? It's the most liquid. Why is that? Because I can use it and take it and use it today, right? If I pay James in cash, he can pay bills today. He doesn't have to wait for payment or whatever. Okay. Accounts receivable, we sell something to somebody on credit. We got to wait for them to pay us. Even if it's with a credit card, James doesn't get that money today. He won't get it till it processes through the electronics. He might get it tomorrow. But if he has a bill due today and I pay with a credit card, he's not going to be able to pay that bill. But with cash, he can pay that bill right away. All right. Inventory is last there just because depending on what the inventory is, if we're a grocery store, it's going to turn over real fast. If we're a tractor company or we sell tractors, we're not going to sell tractors nearly as fast as grocery store sells their product. So inventory might take a while. So that's usually last. Then we have our physical property, PPE, property, plant, and equipment, our tangible assets, right? Things we can put our hands on. Okay. Um, and then we have things like intangible assets, patents, copyrights, trademarks, things like that. Okay. When we flip over to the liabilities side, you can see we have current liabilities. Matt, when do we pay current liabilities?
Like within the next year, I think.
Yeah, they're very good. Within the next year. Normally, accounts payable, okay, is going to be something like 30, 60, 90 days. Notes payable is usually 90 days to a year out. Okay. Now, remember, whose money do we want to use to run our business?
Someone else's.
There you go. So what we do here is if and James has, let's see, James, yours isn't too good of an example for this. I'm going to have to. So let's talk about Saunders has, hey, we're going to work on this AV light system and we're going to install it in this church, right? But I don't have that in my inventory. I'm going to go buy that from my supplier. I'm going to put that on accounts payable. And Saunders is going to ask Matt, hey, can I take 60 or 90 days to pay you? Right? So that's his accounts payable. Now, what he wants to do is go put that into church, and then he wants the church to pay him in 30 days. So now he's using the church's money to pay his accounts payable balance, and he's using other people's money to run his business. Does that make sense? Okay. Now with the notes payable, that's just, we're taking a longer term on that. Okay. Then we have long-term debt and we have owner's equity. Okay. Now with owner's equity is made up of a couple of different things: common stock, paid in surplus, and retained earnings. Okay. Now, if we look at this, and you saw this up here, the balance sheet is a snapshot of our company at this point in time. Okay. Remember, the balance sheet is a picture of your company at that exact point in time because it can change day to day, week to week, or whatever. If Saunders goes out and over the course of lunch, they decide, hey, we made a deal to buy a truck. their company's balance sheet just changed from the morning to the afternoon. Make sense? He's got an asset, but he's also probably going to have some liabilities over there, the long-term debt or whatever, unless he pays cash. And even then, the cash is going to go down, but the property, plant, and equipment account will go up. They're going to go up the same amount. Okay. So understand the balance sheet is a snapshot of your company at that point in time. Now, how do we tie in what we talked about in chapter 1? Talk to me. When we started chapter 1, what was the first thing we talked about?
Capital budgeting.
Okay, Malcolm. And with capital budgeting, what did we talk about? What was the capital budget?
It's the managing of long-term assets and liabilities.
Yeah, what did you invest in, right? Well, folks, what you invest in, your property, plant, and equipment will determine what inventory you have and what your accounts receivable are going to look like and what your cash situation is going to look like. You see that? So when I look at my balance sheet, this left side over here, my assets, that's my capital budget. That represents the capital budget decision. What's my total investment in my company? Okay. So if that's the case, what does the right side of the balance sheet tell you?
Your capital structure.
Your capital structure, right? Because remember, we figured out first, how much money do we need to get into business? The second thing we needed to figure out is where's that money coming from, right? So if we look at it, notice this part right here is my debt. And this part down here is my equity. Folks, money only comes from two places, debt or equity. Remember that. We're going to hit that over and over and over and over again. Money comes from two places, debt or equity. Just like you guys at school, you're either paying for school yourself or you're getting student loans, right? And maybe it's a combination of the two. Hey, I'm working, so I'm paying for some of it, and I'm also getting loans. So money only comes from, and I don't care what you're doing in life. This is a fact if you're in business or if you're not in business. Money only comes from two places, debt or equity, okay? So you see the left side of my balance sheet is my capital budget. The right side of my balance sheet is my capital structure. Where did the money come from? Does that make sense? Is everybody good there? Okay. Notice, and we'll come back to this in a little bit. Total assets, it's a balance sheet, so my left side has to equal my right side. Okay. Now, Matt, you mentioned liquidity. Okay. Liquidity, you said how quickly assets can be turned into cash. 2 points there. Quickly and assets. When we talk about liquidity, liquidity has two components, one being time, the other being value. Okay. Can any asset be made liquid? Matt, you're bobbing your head. What do you mean?
It can, but it kind of depends on what it is. So like a building may become longer. It may become liquid longer.
Yeah, but maybe or maybe not, right? How could that building become liquid faster?
If you sold it cheaper.
Exactly. So what just happened to the value of the building?
It decreased.
It decreased. So Noah's into refurb and they're flipping and all that stuff, right? So hey, if this building, I'm in Peacock right now. If ASU wanted to sell this building and put $1 million on the building, would it sell very fast?
I would think so.
Maybe, maybe not, right? Noah, if ASU had 10 grand on this building, you think you'd be interested in buying it today?
Oh, yeah.
Exactly. So understand, I just made that the liquidity, it became very liquid, but the value went down quite a bit. Why would Noah buy it? Hey, look, it's right there at campus. No, you don't have to worry about parking or getting around. Noah could buy it. He could either tear the building down and build apartments and rent it to college students, or he could come in and refurbish the building and try to rent it to college students, right? At $1 million, that's a pretty big pill to swallow. Because, hey, especially if you're going to tear it down. I'm going to put out $1 million, then I got to pay to tear it down, then I got to build something on top of it. Long term, it'd pay off, but it's going to be a while. At 10 grand, man, that's a no-brainer. Done. Give me the deed because I'm tearing it down tomorrow, right? And especially when you think ASU wants to go to 25,000 students, you got to put them somewhere. Okay. So does everybody understand the time and the value piece? How that fits liquidity? Ladies, Julia, Megan, you ladies have your cameras on. Are you good with that?
I have a question. I understand that humans are a valid asset to a business. So how would that work with your assets turning into cash? Would that be like severance pay?
No, by you being there, you're doing something to generate a product for the business that I can sell. Right? I mean, if it's a restaurant and you're not there to serve the people, then the value's not there, right? If it's like James and you have the computer knowledge that James needs, he needs you there to write the programs or whatever he's doing for his customer. So that's the value.
All right, cool. Thank you.
Okay, does that help out? Okay. All right, so is everybody good about liquidity? All right. Now, let's talk a little bit about something here. Let's talk about debt versus equity. Now, debt, we said money only comes from two places, debt or equity, loans or ownership, right? Okay. Is debt a bad thing?
Not always.
Not always. Matt and James, what do you mean? You guys got to tread lightly on this one because you know if you're wrong, I'm going to tear into you.
Well, I was going to say because like on the liability side, at least an account payable is something owed to you sometimes, or no, that would be an account receivable. Never mind. James,
okay,
your
James
turn.
could bail him out.
So debt can be good in a couple ways. I mean, like personally, having debt builds your credit, this, that, and the other, but debt's only good if you can pay it off.
Exactly. So here's now Matt and James have me for personal finance, so that's why I'm kind of have them on a little different situation here, and why I said I could get into them a little bit. Folks, on a personal level, debt, you should avoid debt like COVID. I mean, run from it. Put your mask on, sanitize yourself, distance, whatever. Okay. On a business level, it's a little different. Okay. The one thing with debt is an equity multiplier. Okay. What do we mean by that? So let's take James, for instance, or Sanders or Noah. This could be either one or any of you guys that want to have your own business, right? So you want to have your business. We're not going to put dollars amount on it. Let's just say your business is one business. And let's just say it's worth $1 to keep it as simple as possible. We could put any number of zeros. We can put any dollar amount on there. Now, if Noah only has 55 cents to put into his business that's worth $1, does the 55 cents equal $1? I hope everybody shakes their head no, right? So to get to that dollar, Noah has to go out and borrow 45 cents. By borrowing that debt turns his 55 cents into $1. Okay? Equity multiplier. So remember this equation, folks. Listen to me carefully. Put this equation down in your notes right there. You need to know that equation. Okay? And if you look at it, we have total assets equals, look at our balance sheet, right? Total assets equals total liability. What's my liability? Debt and equity. So if I look back at this equation, total assets equals total debt plus total equity. That's my total liability side, okay? Now, then folks, I'm not just taking for what it's worth and answering. Man, people are in and out dropping. Why, those of you that are getting, why are you getting a degree?
Make more money.
Make more money, right? In the previous class, somebody said, I need a degree to make money. That's not true. You can make money without a degree. The key is, what'd you say, Matt?
To make more money.
Make more money, right? That's why you guys are coming in here and investing in a degree, okay? Now, anybody, how many are paying for it themselves? Anybody? James is, Julia, a couple of you, okay. Anybody getting student loans? Why are you, Saunders, Caleb, why are you willing to take on that student loan?
Because I had no other way to pay for it. I was just late on scholarships and stuff like that.
Okay,
I see it as a return on investment so I can afford school and make more money later on.
hey, I know without a degree, I can make money, but I can't make what I can with a degree, right? So Caleb, you're saying you're willing to take on the debt because you're going to be able to make a higher income and be able to pay that debt back, right? And that's the whole, and again, that goes back to business versus personal. Okay, now in this regard, as far as job and education, totally agree. If James is going out to get a debt to, hey, I need the latest computer, the whiz bang computer, or I need the latest car to impress my clients. So I'm going to go out and buy a Lexus LS 460. I'm going to tell James you're stupid. Build your business. You can build your business with a decent car. They aren't looking at it. I could care less what type of car you drive up in. If I need you to fix my computer, I need your computer knowledge. I could care less that you drive up in a nice car or beat up car. In fact, I'm going to be more impressed if you drive in an older car or Honda, because then I'm like, this dude's business savvy and understands me from a business point of view, right? Now, if he's made millions of dollars and his business is rolling and his business can pay for that car, totally different story. But to say I need that car to impress clients to have business, mistake all the way, right? So you folks are here getting business degrees, and this goes back to some of the thought process that, oh, college should be free. No, college shouldn't be free. You have the right to make a decision. Caleb understands he's a business major. I'm assuming, right? You're in 3680, so you're a business major. Now, if Caleb was going to be I'm studying history, and you're studying history and getting student loans to study history, I would probably tell you, Caleb, a history degree isn't going to give you a higher income to offset that debt you're paying or taking on and pay off, right? So then at the end of it, he's like, wait a minute, I took all this debt on and I got this degree, but I can't pay the debt, so everybody else should do it for me. No, that's because you studied the wrong thing. That's not everybody else's fault. That is your fault, and you took that debt on, okay? So understand with debt, in a business sense, it's good. It's an equity multiplier. On a personal side, avoid it like COVID as much as you can, okay? What we mean, and the thing with debt is a double-edged sword. So Caleb, if you go out and get a higher paying job and you can pay the debt off, it worked for you, right? Debt allows us to increase, it makes our highs higher. Great, Caleb, he followed the plan, got the debt, got the degree, got a higher paying job. Now he's getting raises and things like that. He's making more income. He's paying the debt off. Great. Caleb, what happens if COVID continues and when you graduate, the job market's not doing too good and you can't find a job?
I make less money and I get more debt.
Exactly. This is the double-edged sword of it, is it makes our highs higher, but on the flip side, it makes our lows lower. So Caleb goes out and gets that history degree. With a history degree, you're either teaching or working in a museum. I'm sorry. I think those are about the only two options you have. Okay. If they aren't hiring, then you're strapped, and now you got all the debt and the interest that you have to pay off. So not only do you have the debt, now you got the interest on top of it. So see what I mean by it makes your highs higher and your lows lower, puts you in a deeper hole that you got to dig out of. Okay. Is everybody good about debt versus equity and equity multiplier? Does everybody see how it fits on your balance sheet? Is everybody good there? Okay. The other thing, folks, this is the spreadsheet. Like, here's your amortization table. If you look, statement of cash flows, you can refer back to this. You guys can take this if you want it. There's your balance sheet. Here's your income statement. So this is what we're talking about in chapter 2. Okay. Chapter 3, we're going to talk about sources and uses of cash, statement of cash flows, and your financial ratios. So on this one sheet, we have chapter 2 and 3 that we're going to be covering. And like I said, you're welcome to take this. This is something I made back in grad school. If you want it, take it. Not a problem. I don't care. If it'll help you out, by all means, take it. Okay. The good thing is most of the time your income statements and balance sheets are very basic, and you can change these how you need to. Okay. All right. So, and is everybody good on this equation right here? This is going to be key. You need to remember this. Okay. All right. Let's talk about market versus book value. What is book value? You remember book value from your accounting class?
What you bought it for?
Partly, Sandra.
But it's
Or what you
worth
recorded
today.
it as?
What was that, Matt?
I said what it's worth today.
Okay. Nah, maybe not. Malcolm, what were you saying?
Is it the appraised cost, like what somebody says?
No, not quite. Remember,
What the
Sandra
business
was-
has,
Julia, what?
what the business has written in their side of the transaction of what?
Okay. You guys are you're dancing around it, but not quite on the bullseye. So let's nail it down for you. Okay. Book value, initial cost or historical cost, depending on how what you were told in accounting 1. I usually say initial cost. Okay. Minus depreciation. Now what's depreciation?
Like depreciation of office equipment or assets, tangible.
Okay. So what is that though, Noah?
An expense?
It's an expense, yes. Depreciation is how much of it how much of the value of the asset have you used up, right? So it's the initial cost minus how much of that initial cost have we used up. That's what it's on our books for. So the day we buy it, the initial cost, we haven't used any of it. So the book value is what it's on what we paid for it, right? A year later, now remember, when we calculate depreciation, there's 2 ways to calculate depreciation. You remember those? Anybody remember straight line depreciation?
Straight line and then usage.
Yeah, so Noah, let's say you bought this building, right? And you were going to renovate it. 10 years, you paid the $1 million for it, and you're going to depreciate it for 10 years. That means each year you use up $100,000 of the value, right? So 2 years from now, your book value on this building is the $1 million minus 100 minus 100. So the book value is $800,000. Is everybody good there? Does everybody understand depreciation and book value and how that plays in? Okay. The other way is something called MACRS, M-A-C-R-S, or MACRS, or whatever you want to call it, Modified Accelerated Cost Recovery System. Okay. We're not going to depreciate it generally on a straight line. What we'd like to do as business folks is we kind of skew our depreciation to the beginning, where James is learning how to do his business and all that. So he wants to have more depreciation up front, because that, like Noah was saying, that's an expense and comes out. So it's going to lower his taxable income and lower his taxes and things like that. And then as he perfects his business practices and builds his customer base, and they help bring business to him, and he gets an understanding of his business, now we're going to take less depreciation out. Okay. That's why you go invest in another asset, but we'll talk about that when we do the problems for chapter 2. Okay. But the MACRS is it's different levels. There's like a 5-year, 7-year, maybe it's 3, 5, 7, and like buildings are 30 years. Depending on if it's commercial or residential, one's 29 years, one's 30 years or something like that. Okay. Now, so that's book value. What's market value?
What somebody's willing to pay for it.
Exactly. What somebody's willing to pay for it. Now, think about what you learned in accounting and what we said the other day. Okay. If you remember, we said we're not too worried about the P&Ls. We don't worry about profit margin. Profit margin just tells me what kind of business I'm in. Low margin, high volume, or high margin, low volume, right? No, if you could make 75% on a building, you'd love to turn them over all the time. You'd love to be turning one a day. That's a lot of buildings. You got to have a lot of people doing that. You also have to have a lot of money to do that, right? Yeah, I had one student one time that, they were talking about McDonald's was they were opening a McDonald's at one time, like every 15 seconds. They said, how do they build them that fast? And they don't build them that fast. It's just, there's so many being built that's how quickly it seems they're opening. Okay. So with market value, think about finance. Are we worried about book value or market value?
Market.
Market value.
We're worried about market. I could care less what it's on my book for. That's just like this building, right? If it's $1 million, it doesn't matter if I have it for $1 million on my books. What only matters is what somebody's willing to pay for it. Quite honestly, I think if this building was $1 million, it wouldn't be here. It wouldn't be on the market very long, right? It would go quick. We worry about market value. Remember, finance, we worry about cash flow, money in versus money out. So we worried about cash flow. So in finance, market value is what we're concerned about. Okay. Is everybody good? Any questions on balance sheets? All right, let's talk about income statement. Income statement. If you think about an income statement, by the way, before I forget, on page 23 is a balance sheet. We may refer back to that. I think when we do the problems, we refer back to that quite a bit. On page 26 is a basic income statement. When you're looking at balance sheets and income statements, folks, don't let the verbiage throw you. Sometimes you'll see sales, like here it says net sales, cost of goods. Sometimes it'll say revenue, costs, expenses. It might say income and expenses. Don't let the verbiage, different companies use different verbiage. Don't let that throw you off, okay? So when we look at an income statement is just revenue minus expenses, and that gives us our income. Well, we're gonna expand ours out a little bit, and you can see here we have revenue minus cost. Now, folks, on this one little line, we got costs, but I want you to understand there's a lot of things going into costs. So what do you think some of the costs for a business are?
Labor, like wages.
Labor and wages. What else?
Materials.
Materials. What else?
Your building.
Building. Yeah. Rent, mortgage. What else? Utilities in the building, lights, water, right? Insurance. So what I hope you guys are getting the picture. When it says cost, there's a lot of things going into that box that's cost, okay? Understand that, because we're going to put costs and we're going to have a dollar amount. And it's going to be this one line, but there's a lot of stuff in that one line, okay? Then we have depreciation. We said depreciation was an expense. It is a non-cash expense, okay? That gives us our EBIT, or earnings before interest and taxes. So then we take out interest. That gives us EBT, earnings before taxes. Once we take out taxes, then we get the net income, okay? Now remember, we said money only comes from two places. What are they?
Debt and equity.
Debt and equity. Net income only goes two places. Any ideas? One is dividends. Anybody know what the other one is? Retained earnings. Okay. Remember when we talked about the figure on page 14, cash flow through the system there, how the money flowed through the system, right? Where was the biggest arrow going? Back into the
Back
company.
into the company.
Very good. Retained earnings. We were putting that back into the company. You remember what we called that? What did we call that?
Plowback.
Plowback. Okay. So we called it plowback. All right. Now, let's think about chapter 1 and what we talked about in chapter 1. Okay. Look at our capital budget decisions. What was the capital budget decisions again?
To buy a piece of equipment or not.
What we invest in, right? What we invest in is going to determine what on our income statement here. Costs and depreciation, right? For James's company, like he said, he needs some server space, computer, and not a whole lot else, right? Maybe some software. Saunders said, hey, we need a warehouse, we need trucks. So look at their two businesses. They invested in totally different things. What's the cost structure of James versus Saunders company? What's going to be the depreciation? So you can see your capital budget decisions are reflected in the top part of your income statement. Does that make sense? Okay. Then look down here. Interest. What causes interest?
Debt.
Debt. Why do we need debt? Because we didn't have all the money to put into business, right? So now that kind of reflects our capital structure. Okay. So can you see the decisions we made in chapter 1 are flowing into chapter 2, and we can see it on our balance sheet and we can see it on our income statement and how it's affecting both of those statements. Does that make sense? Okay. So depreciation, costs are reflected in our capital budget, what we invested in. James, did you have a statement? I'm sorry.
Oh no, I was just coughing.
Okay, good. All right. Not good, but good. Okay. I didn't want to cut you off. All right. So revenue minus, when we get down to net income goes two places, dividends or retained earnings. Very important you remember that. Okay. Is everybody good? Questions? All right. So let's talk about taxes. A couple of things I want you to understand about taxes. Really, there's two things. Average tax rate, and see that's total tax bill divided by taxable income. The next thing is marginal tax rate. That's the tax on your next dollar of income. Okay, so I'll give you a second to write that down real quick, and then we'll talk about that. Okay. All right. If you have your books, flip your books to page 30 and 31. I want you to look at a couple of graphs here, or pictures, or tables, or figures, whatever the heck you want to call them. Tables, I guess. On page 30, you can see the corporate tax rates for the year of 2017. Okay. You can see they go from 0 to over $18 million. You can see how the tax rate goes up. It's what we call a gradual tax. The reason it's gradual, and our personal income taxes kind of work the same way, okay? Because as we earn more income, the thought is as you earn more, you can afford to pay more because you have more money to take care of your necessities in life. So you have more disposable income. So you have more room to pay taxes, okay? The other thing I want you to look at the table on the next page, on page 31. You can see taxable income, 45,000. And this is corporate taxes and tax rates. Their marginal tax rate's 15%. Total taxes, and you can see their average tax rate. Okay. Then look at the bottom table. So here's different companies. So we have electrical and utility companies. They're paying 34% in taxes. Then you have biotech, pharmaceutical, and internet paying 6% or less. And you can see the different industries in there, okay? Banking and all that. You can see how many companies, okay? The other thing I want to point out to you, look at the paragraph above that table. Read that first sentence. Prior to 2018, with a tax rate of 35% for large profitable companies, the U.S. corporate tax rate was the highest in the world among developed economies. Think about that for just a minute. Okay. Now, folks, you're going to have to understand and know how to calculate average tax rate. So let's look at our table on page 30 there, and we're going to do taxes. Okay. So Noah, here you are, buddy. You and your company earned $525,000 in taxable income. So let's calculate your taxes. Okay, you good? All right. So look at our chart on page 30. So Noah, from $0 to $50,000, your first $50,000, that is taxed at 15%. By the way, you guys are going to need a calculator. I need somebody to do the math on this. I didn't plug my little calculator stick in, so I don't have it. So Noah, on your first $50,000 of income, how much taxes did you pay?
$7,500.
Okay. Does that sound too bad?
Not for the first $50,000.
Okay. Now, no. Hey, you were like, wow, this was good. I worked hard. I made money, but I want to make some more. So the next year you grow your business, right? You grow it from 50,001, and we're not going to worry about that dollar. We're going to keep it to set. So you grow it to 75,000. Now notice, you're still from 0 to 50. You're still paying 15,000 or 15%, right? That's 7,500. But on the next 25,000, notice that's now taxed at 25%. So you took your business from 50 to 75,000. So that extra growth, that 25% growth, we're going to tax a quarter of that. So what did you pay in taxes on just that $25,000?
$6,250.
So are you happy about that? You worked real hard.
Oh, heck no.
Okay.
They
Now,
still,
what?
I said that's almost as much as the 50,000 what they took out.
Yeah. Now, notice though, Noah, you're like, hey, life at 50 was good. Life at 75 was better. I want to keep going. So then you go and you work harder the next year and you go from 75 to 100,000. Okay. Now notice that's taxed at 34%. Now that 25,000, what does that come out to be? Just that 25,000.
$8,500.
How do you feel about that one? All right.
I see where we're going with this.
Now, so hey, life at 100,000 was good, but my wife and little Noah, they want more stuff. So I'm going to work real hard. I'm going to get a couple more houses and add on another crew or two. And I'm going to go from, look at the next bracket, from 101 to 335,000. Okay. So that's 235,000, and we're going to tax that at 39%. So what's 39% of that 235,000?
91,650.
How do you feel about that? So you increased $235,000, worked really hard to do it, took on a bunch more risks to do it, and we're going to take almost 40% of that. Hey, no, I don't want to work anymore. You keep working because you're going to give all that to me. All right. Now look at the next bracket though. The next bracket goes from 335 to 10 million. But you didn't get up to 10 million. You only got to 525. So we got 335.01 to 525. So you increased your business. What is that? $190,000. Okay. But hey, to reward you for that, we're going to knock off 5% on the tax. Now it's only 34%. So what do you pay there?
64,600.
Okay. So we got to total this up. That's zero. That's zero. Carry the 1, 6, 8, 13, 19, 5. Right? Carry the 2.
It's 178.5.
178.5. Thank you, James. Okay, so this is his total tax bill. So what do you think about that? No, you're $525,000 for your business, taxable income, and you're going to pay $178.5 in taxes. So we take his total tax bill divided by his taxable income. Okay. What's your tax rate? Your average tax rate?
34%.
34%. Okay. So that's how we, folks, you're going to need to know that. So make sure you have that down. Okay. Now we said marginal tax was the tax on your next dollar. So Noah, you work hard, you earn $525,001. What's your marginal tax rate?
I'm sorry, could you say that one more time?
So the marginal tax rate is the tax on your next dollar of income. So your marginal tax rate is 34%. Okay, does everybody see that okay? So, how you feeling, Noah?
About the tax?
Yeah.
I feel like I want to learn some loopholes.
Ah, imagine that. All right, folks, let's talk about something here. Right here, this level of income right here. What percent of the population do you think makes that income?
15%.
Matt and Jane, you guys should know this because I hit you with this in personal finance. And Matt, that's wrong. You know that. I don't know if you're trying to steer people wrong.
25%.
Oh, no.
More like 8%, I'd say.
No.
One.
You know, are we getting hot or cold or like what?
You're cold. Way cold.
30%.
Way cold.
60%.
Probably much
Going the
lower.
wrong
like
way.
2%.
Folks, less than 3% of the population make $100,000 a year. Less than 3%. Okay. Maybe it might be a little bit more now, but it's around 3%. So what do you think about this level of income right here?
Less than 1.
Yeah, it's less than 1%. Now, let me ask you folks this. Think about it. Less than 1% pay 300,000, make 300,000 or more in income. What total percent of the U.S. tax bill do you think that less than 1% carries? %40 of the total taxes in the country are paid by that less than 1%. So, Saunders, James, Noah, you guys said you wanted to have a business, right? And you want to have a business to make money. Now, let me tell you, Noah, you said this was not good and you weren't happy with this and you wanted to learn loopholes. That is a lot in taxes, but I guarantee you life at, even with that, you're still making, let's see, you're taking home what? If we, let's just say that's 200,000. So you're taking home 325,000. That's still better than living at 75,000, I think, right? Probably. Now, to get your business to that level, what did you do? Hey, I took a much bigger risk. I had to have more properties to flip. To be able to convert those and turn it into income, I had to have more crews, so you employed more people. By employing more people, those people are paying more income tax. You're paying more in Social Security tax. But what are those people doing? Buying and selling things in the neighborhood, right? Now, don't get me wrong, folks. I want you to understand business, folks. Okay? Saunders, James, and Noah. If the people come to you and say, we want you to pay more because you're making more, you deserve to pay more. What's your thought on that?
Personally, I don't like to pay taxes, but I know they're needed.
Okay. If you want to know what eventually, what would you do?
Move.
I'm
I
thinking,
moved my-
about-
What, Noah?
I'm thinking about potential tax deductible methods I can implement to decrease the amount of taxes I got to pay.
Okay.
I moved my business out of the US.
There you go, Malcolm. Exactly. Folks, let me tell you something. Okay. You want to know what would happen if we keep pounding on the top 1% or whatever? Go look at Greece. Study what happened in Greece. Okay. They did the same thing. And eventually, you know what they did? They said, they did what Malcolm did. Malcolm said, hey, those guys took their companies and left Greece. You want it, and that's why Greece, and don't get me wrong, folks, you can study this. I'm just telling you, Greece is broke. Why did Britain want out of the European Union? Because they got tired of carrying the weight of Greece and Spain and these other broke countries who had broken systems, who were like, well, you're making all the money. You guys, you got all the money, keep supporting us and floating us. And Britain finally said, we're tired of that, right? All the billionaires, one of the wealthiest men in the world, Onassis, he was ran all the shipping magnates for a while. He married John Kennedy's ex-wife, Jackie. He completely moved everything out of Greece and said, enough of this. If we do the same thing, folks, it's gonna happen. Look at California and New York. Why are people leaving those states like crazy? Because we're taxing them. They're taxing the mess out of them, and they're moving down here and wanting to turn our state into that state. Man, don't do that. Okay, like Noah said, now you want to learn loopholes, and we're going to talk a little bit about that when we do the problems for chapter 2. Maybe not loopholes, but ways that, and again, it goes back to don't hate the player, hate the game. The person learned to play the game. You don't like it? You don't like what they do? Well, go learn to play the game the way they play it, and you'll be doing the same doggone thing. Okay? And you'll see when we do the problems what I'm talking about. All right. Questions? Everybody good? That's a good stopping point, because when we come back, so we covered taxes, okay? When we come back, we're going to talk about operating cash flow, and we may get into some of the problems too. So you might want to look at some of the problems. So remember, for Tuesday, read the chapter, do your quiz, maybe look at some of the problems. The cash flow stuff, I like to spend a lot of time on that, and I'm not going to get into that right now because I think I'll have generate a lot of questions for people. Okay. So we'll save operating cash flow for Tuesday. We can roll through that, work some problems. we'll probably spend about 20, 30 minutes on operating cash flow, depending on questions. Okay. All right. There's only 21 of us in here. So either we've lost 10 people or 10 to 12 people have dropped the class. I don't think that many dropped, but not the time to be skipping classes, guys. I'm just telling you, if you see some of these other folks or know them, tell them they need to either watch the video. I'll try to get it posted, or watch the videos. I'll probably put those up this weekend. Okay. Any questions? Understand, folks, main thing, if it works for business, it works for you in your personal life. Okay. You guys are here studying business so you can make these income levels. And I pray all of you do. I would love for every one of you guys to be at the top bracket there. Okay. Takes a lot of work and a lot of discipline. A lot of it. Folks, when I had my restaurants, I was working 14-hour days, 6-7 days a week sometimes. I took no more than a 4-day vacation when I had my businesses, because my phone rang constantly with questions from managers and people that were supposed to be able to run it without me. Okay. The other part of it, Noah, and James and Saunders and the rest of you, why do the business, I hear these people talk about, well, business owners don't need to make that much. Well, they're the ones taking all the risk. An employee took 0 risk. None of my employees took any risk in my business at all. I financed my house and everything I own to get those businesses going. I took all the risk on. Why should I not take on or benefit from taking on that risk? Why should any business owner benefit, not benefit? It'll be interesting. Do you guys know did you guys see they started a socialist club on campus? That made the paper the other day.